Hi, accounting class. You have read and taken notes on chapter 12 at this point. And just because it's another new chapter and I'm not here to guide you as I normally would, I do want you to do the chapter 12 questions that can be found on pages 593 and 594 of the book. If you go to page 593, you'll see questions 1 through 11, and when you skip over to the next page, you'll go through question 17. You'll notice 18 through 24 are asterisks, which means that they would be the appendix-based questions, which we never do. So my intent is that you probably do these before you're watching this video. I'll read aloud the question, and then I'll provide a response based on the answer key and maybe make a few extra notations. So without further ado, let's get started. Again, I'm reading question 1 on page 593. It reads, the characteristics of a partnership include the following: A, B, and C, and they're asking you to explain each. So let's start with A. The association of individuals is basically a partnership that is a voluntary association of 2 or more. Remember, the key word there is or more. Partnerships, although it sounds like 2 people, could include more than 2. Based on a simple act of a handshake. I know that seems a little bit funny that you could form a association of an individual-based partnership on a simple handshake, but it is considered legal. However, and I'm glad there's the however, it is preferable that the agreement is in writing. A partnership is both a legal entity and an accounting entity, but is not a taxable entity. Basically, each owner is taxed based on their share of net income, kind of like a salary, if you will. And I see there's an error here. This should be B and C. B is asking about a limited life. A limited life partnership does not have an unlimited life. A partnership may be ended voluntarily or involuntarily. Thus, the life of a partnership is indefinite. Any change in the members of a partnership results in a dissolution of the partnership. So basically, it can be voluntary or involuntary, giving the life an indefinite partnership. And C, co-ownership of property. Partner assets are co-owned by all of the partners. So for example, if there is a company car, it's technically owned by all of the owners. If a partnership is terminated, the assets do not legally revert to the original contributor. If a partner has a claim on total assets equal to his or her own capital balance, this claim does not attach to specific assets the individual partner contributed to the firm. So the company car belongs to the company. If a partner is let go, so to speak, the company car stays with the company. On to question 2. Kevin Mathis is confused about the partnership characteristics, and admittedly some of you maybe are too, of a mutual agency versus an unlimited liability. Explain these 2 characteristics for Kevin. When taking a look at a mutual agency, it's a characteristic that means the act of any partner is binding on all other partners when engaged in the partnership business. This is true even when a partners act beyond the scope of their authority. So as long as the act appears to be appropriate for the partnership. And B, unlimited liability is when each partner is personally and individually, the key word here is individually, so on a personal basis, liable for all partnership liabilities. Creditors' claims attach first to partnership assets and then to personal resources of any partner. What you need to know is if a partner in an unlimited liability situation has financial problems, they're first going to attack the partnership and then go on to their personal resources. Number 3. Lance Konoski and Matt Morrison are considering a business venture. They ask you to explain the advantages and disadvantages of the partnership form of organization. And number 3's answer solution outlines advantages and disadvantages. Advantages of a partnership: basically combines the skills and resources of 2 or more individuals. You know, the names would be, you know, Lance is maybe a real good money guy, and maybe Matt is your salesperson. You know, so Lance's shortcomings might be Matt's strengths and vice versa. Yeah, they're easy to form. We found out in a previous one it can be a simple handshake, but the preferred method is a written contract. It is freed from government regulations and restrictions, which is a huge advantage, and it makes decision making easier if people can get along. That 4th one could go awry very quickly because if you can't get along with your partner, then there's of course issues. Some disadvantages would be the mutual agency piece, a limited life, and an unlimited liability, meaning they could attack your personal pieces. Number 4, why might a company choose to use a limited partnership? A limited partnership is used when a general partner wishes to raise cash without involving outside investors. So in other words, the 2 partners, let's just use Sally and Susie, they don't want to go and get other investors. They're going to contribute themselves with the limited partnership. Outside investors, are not going to be a factor. Limited partners in this case have limited personal liability for business debts as long as they don't participate in management. Number 5, Newland and Palermo form a partnership. Newland contributes land with a book value of 50 and a fair value of 60. Newland also contributes equipment with a book value of 52 and a fair value of 57. The partnership assumes a $20,000 mortgage on the land. What should be the balance in Newland's capital account upon formation of the business? So if you take a look, again, there's 2 partners here, but this seems to be focusing just on Newland. We're looking at his capital account because remember there would be 2 capital accounts if there's 2 partners. His value is 97 with the land at 60, the equipment at 57, less the debt owed of 20,000. And you can tell that they're basing that 60 and that 57 on the fair value or the going rate of that land and equipment. Number 6, W. Jensen, E. Emk, and W. Gilman have a partnership called Outlaws. Now you'll notice we have 3 partners here, even though it's called a partnership. A dispute has arisen, which is inevitably going to happen in scenarios from time to time among the partners. Jensen has invested twice as much in assets as the other 2 partners, and he believes net income and net losses should be shared in accordance to the capital ratio. So in other words, the more you put in, the more you get out. The partnership agreement does not specify the division of net income or net loss or profits and losses. How will net income and net loss be divided? When it's not specified, when they do not specify, it should be divided equally. I'll use a scenario of a 50, 25, 25 with the 3 partners. Maybe one person puts in 50 and he would get, of course, 50% of the net income with the other 2 partners getting the 25 and 25. But if it's divided equally, you'd take the 3 partners and divide it by 3. Whether or not, and if you don't specify, if you don't specify, they're going to be divided equally, whether the big shot put a bunch in or not. And likewise, if it is a net loss, they divide that as specified, but if not, they divide that equally by 3. Number 7, Mutt and Jeff are discussing how income and losses should be divided in a partnership they plan to form. What factors should be considered in determining the division of net income or loss, kind of like what we just described in number 6. A few factors. Using a fixed ratio is an easy way to apply. and may be an equitable basis in some circumstances. A second option would be capital balance ratios. So you're seeing a lot of ratios here, which we know has math involved. When the funds invested in the partnership are considered the most critical factor. So, you know, what are you bringing to the table? Are you going to buy the land? Are you going to buy some equipment? Or number three, a salary allowance or interest allowance coupled with a fixed ratio. So number one plus, you know, what kind of money are they taking home? This last approach gives specific recognition to differences that may exist among the partners by providing salary allowances for time worked and interest for capital invested. So basically, they're working a little bit and they're going to get a salary in addition to what they brought to the table. Number 8. M. Elson and R. Ogle have a partnership capital balance of 40 and 80 respectively. So Elson brought in 40 and Ogle brought in 80. The partnership agreement indicates that net income or loss should be shared equally. If net income for the partnership is $42,000, how much net income should be divided? And you'd basically just divide it by 2. I question this. I see that, you know, that's what was originally decided, that it would be divided equally, but you'll notice Elson only originally put in 40K and R. Ogle put in 80K, so that is not an equal difference, but that's how their partnership was set up. Number 9, S. Pelcher and F. Holt share net income and net loss equally. Which accounts are debited and credited to record the division of net income? So at the end of the year, net income comes in. What are we debiting and crediting? And then there's a B section, which we'll cover in a minute. Remember, this is part of the closing entry process. You close sales into income summary. You close expenses into income summary. Hopefully there's more sales than there are expenses. And then you close the income summary into the capital account. Well, now there's 2 partners, so we just have to divvy it. Some's going to go to one partner, the other's going to go to the other partner. So we're debiting income summary to close or zero out. And we are crediting each capital account. Now that's where we saw only one capital account before, but we're just going to split the difference between them if it is an equal split. Then part B, the what if. What if S. Pelcher withdraws $30,000 for personal use in lieu of a salary? Which account would be debited and credited? Well, we're using cash. Cash is our credit that would be going down. And the drawing account for just this partner would be the debit for $30,000. We're on to number 10. We've got a few more partners. T. Greer and R. Parks are provided salary allowances of 30 and 25 respectively. They divide the remainder of the partnership income into a ratio of 3 to 2, meaning they're each getting paid 30 and 25 respectively, but then any net income they're going to divide by a 3 to 2 ratio. If the partnership net income was 40 grand, how much would each partner get? You certainly wouldn't have to have it set up this way in your response, but it does break it down nicely. Go ahead and pause the video if needed to record it. But we're taking a look at their salary allowance, showing what each of the folks got, totaling $55,000. You might wonder where the 60 and 40 came from. That looks like that's the partner division split. With the 3 to 2 ratio. Sorry, I lost my place in the book. You might wonder where the deficiency came from. Well, you take a look at the net income of $40,000 minus their salaries that they had paid. So we're looking at an actual loss or a hit of the difference of $15,000. So that would be money out because they paid themselves more than their net income. One more on page 593. We're looking at number 11. Are the financial statements of a partnership, similar to those of a sole proprietorship? And please discuss. They are similar. The same basic rules apply of assets equal liabilities plus owner's equity. There just happens to be two or more. And from the balance sheet perspective, from the income statement perspective, yeah, it's revenue minus expenses equal hopefully a net income, but then how is that divided among the partners? And again, that has to be set up at the time of the partnership creation. So they are similar, but the answers also talk about the differences. The differences are due to the number of partners involved, 2, 3 plus. The income statement for a partnership is identical to that of a sole proprietorship, except there's more information on how the net income is divided, as we already mentioned. And the owner's equity statement, which I didn't put up there, my apologies, would just show each of the partners' capital. This statement shows the changes in each capital as they've progressed through. And on the balance sheet, you will see each partner's capital balance as part of the owner's equity section. So it's just more involved because there's two or more owners. Okay, on to number 12. That would, of course, be a page flip to page 594. Number 12 reads, how does the liquidation of a partnership differ from a dissolution of a partnership? The word liquidation, of course, to me means how quick can we get that into cash? So the response, I'm having some technical difficulties here. Reads as follows. A liquidation of a partnership ends both the legal and economic life of the entity. Meaning they are liquidating all of their assets, they're turning it into cash and walking away. Partnership dissolution occurs whenever a partner withdraws or a new partner enters in. So the partnership's still going, it's just that they're changing partners, adding or sending a few packing. Dissolution does not necessarily mean the business ends. So you'll see the big difference. Liquidation ends the economic and legal life of the partnership. A dissolution doesn't necessarily mean it ends. Rather, any continuing partners agree, the continuing partners agree, operations can continue without any interruption. So dissolution means that things are going to keep going, it's just maybe there's been a changing of the guards, versus a liquidation means we're getting cash out of the deal and walking away. 13, Roger Fuller and Mike Rangel are discussing the liquidation of a partnership. Roger maintains all the cash should be distributed to partners on the basis of their income ratios. Is he correct? Explain. No, Roger is not correct. All gains and losses on the liquidation should be allocated to the partners on the basis of what they originally set up as their income ratio. However, final cash distributions should be based on their capital balances. So in other words, what they're worth in owner's equity. Number 14, in continuing their discussion from question 13, Mike says that even in the case of a capital deficiency, all cash should still be distributed on the basis of capital balances. Is he correct? Yes. Capital balances are used because they represent the individual partner's owner's equity in the partnership. So they're skin in the game, if you will. The objective of the distribution is to eliminate the balance in each of their capital accounts and turn them into cash based on what 13 is saying because they are liquidating. Number 15, we're almost done. Norris, Madsen, and Howell have income ratios of 5, 3, and 2, assumingly that's respectively, yes. And capital balances of 34,000, 31,000, and 28. So you see that difference of 5, 3 to 2. Non-cash assets are sold at a gain. After creditors are paid, in other words, we've paid our payables, $103 of cash is available to distribute to the partners. How much cash should be paid to Madsen? Madsen is this person in the ratio. After they've paid their bills, it looks like we have $103 cash on the table. In taking a look at the three capital balances of 34, 31, and 28, this one being the gentleman we're talking about, we're looking at a $93,000 balance. And we've got a $10,000 gain then after we've paid our bills and we've looked at what each of their owner's equity or capital balances are. And then we'll take that remaining dollar amount. In this case, it's excess or a gain on the sale of every non-cash asset. We're looking at $10,000 times 3 of 10. And at that point, cash to Madsen would be his owner's equity or capital balance plus that $3,000 split 3 of 10. Before the final distribution of cash, account balances are listed. I won't read all of them. LUSI is unable to pay any of the capital deficiencies. If the income sharing ratios are 5, 3, and 2 respectively, how much cash should get paid to L. Seastrom? Again, listed here, a capital deficiency of $4,000 with a loss. The 4,000 times 3 of 8. If you're still confused on that 3 of 8 or the 3 of 10 that was talked about earlier, please reread that section of the book. We'll talk more about it in depth when I return. And taking a look then, cash to Seastrom, the $12,000 as mentioned in the problem, minus what happened here. It looks like he will walk away with $10,500 based on all the deficiencies and his, what's the amount, his capital. We finally have reached the last question for the questions. Number 17, why is Apple not a partnership? A partnership is an association of 2 or more persons to carry on as co-owners. Apple, however, is considered a corporation where stocks are publicly traded, and actually the owners become what are called stockholders or shareholders, and they have thousands of owners. Basically, any one person who owns even one share or stock, those two can be used interchangeably, is an owner. So it is not considered a partnership because it's a publicly traded corporation.